Seth and I were talking last night. He told me all the great stories about what you all did at your party last night, because I hear it was quite exciting. So again, as Seth said, thank you for showing up this morning after your night of revelry. I hear it was a great party, so happy holidays and Merry Christmas. I want to start off this morning with just a little bit of, hopefully, some practical information before we dive into fraud, and I tell you a bunch of what's going on in the market, which is a little bit of a downer. So I got this week, you know how you get in your emails all these practical things and you think you're going to read them every day and you just get overwhelmed with it? Well, every once in a while I find one that seems to have some practical value. So I thought I'd share this with you. This was an article in the Harvard Business Review, and it's entitled, "I Don't Understand What Anyone Is Saying Anymore." Have you ever felt that way? And actually, when I was reading this, I was thinking, you know, all the holiday parties we have to go to, and you're meeting new people that you haven't met before. In fact, I just had this happen at my holiday party, and I asked someone what their husband did. I know what you do. What does your husband do? And at the end of about 5 minutes, I had no idea what her husband, she used words like logistics about her children. And I'm thinking, what does that mean? She works the logistics of my children, so I don't know. But here's what this author has to say, and I'll give you a challenge, a practical challenge as we start off this morning. I don't understand what anyone's saying anymore. I'd say that about half of my business communications, I have almost no idea what other people are saying to me. When I was younger, if I didn't understand what people were saying, I thought I was stupid. Now I realize if it's to the people's benefit that I understand them and I don't, then they're the ones that are stupid. So here are some examples of how we don't understand each other anymore. The first one is called abstractionitis. We've forgotten how to use the real names of things. So instead of using the term doorknob, for example, people talk about the idea of doorknobs without actually using the word. So an idea becomes an innovation in residential access instead of saying the word doorknob. Expose yourself repeatedly to this extrapolation of this practice to things more complicated than a doorknob, and you really just need to carry Excedrin around with you all day long. So, talking in the abstract, which is the example of what my boss's husband did. I have no idea what your husband does now. Here's another one that you all might be guilty of. I know my husband's an attorney and he's guilty of it all the time. Acronymitis. This is a disease of epic proportions. You have a conversation and they use these acronyms. He gives the examples SCEA, and he said another one that starts with an R, and I don't even remember the rest of it. In the span of 3 minutes, those acronyms were used at least 8 times each. They were central to any understanding of that topic being discussed, but they were never defined in the discussion. So he had not the vaguest idea what they were talking about. So that's acronymitis. And then the author here calls it Valley Girl, but I call it filleritis. So this is when you don't know what to say. You have a saying that you say. Some people say like, some people say so, like they finish every sentence with the word so. Hey, it's great to see you, so, and it's like they just dive off. Well, he says here, and okay, this is really great when you hear somebody talking on the cell phone, because you're not hearing the other side of the conversation. He said he listened to a cell phone conversation, and this was what he heard. And she was like, and I was just like, no way, really? Like, yeah. When she was like that, I was just like, so. So you can go on for extended periods of time. Now, in the business world, though, we can sometimes use different words like space and around and synergy and value add, so that they really don't have any meaning at all. Some things like that we might use sort of or kind of. It's kind of like this, or it's sort of like this. So that's Valley Girl or filleritis. And then the fourth one is meaningless expressions. So meaningless expressions are things like, let's think outside the box. What does that mean? Because it could mean something different to anybody you're talking to. Of course, there's many more, but here's another great one that could apply to all of us in this room. It says, let's exceed the customer's expectations. It actually kind of sounds good, but the point is, if you have to tell people that you're going to exceed your expectations, then you're kind of missing the point. I also have this saying, if somebody tells me to believe them because they're telling the truth, I am going to question it. Why do they have to tell me they are telling me the truth? Okay? So he said he walked into a hotel and it says, our goal is to meet your expectations. Well, and his point is, most of the time, we are good if we just meet the expectations, much less exceed the customer's expectations. So it's kind of a meaningless expression. So they also have a disease they call where you put all four of those diseases together. So you use acronyms, you use fillers, you have meaningless expressions to the point where, as we say, I don't understand what anyone is saying anymore. And you know, we have a lot of the Facebook and the Twitter. Now people are actually talking like that. Like people go, oh, LOL. Which I think, isn't that laugh out loud? Isn't that what it actually means?
Yeah.
Okay. Yes. Oh, they go, OMG. That's the latest one too. All right, so to close this, it says, this would all be funny if it weren't true. People just don't make sense anymore. So save yourself a lot of trouble if you internalize this. Appreciate just how ridiculous most business conversation has become. And if you do that, you'll gain tremendous credibility, become much more productive, and make those around you more productive. And you'll have more joy in working in your life. And if you need to, every once in a while, look someone in the eye and say, I don't have any idea what you just said to me, to clarify. So to be reactive, if you're on the receiving end of one of these, I do this all the time. Like I said with my husband, he uses these acronyms, and I just go, what does that mean? Because I have no idea the entire train of thought if you cannot tell me what that acronym means. I have no idea what you're talking about. So don't be afraid to ask. And then you can also be proactive and yourself try to avoid your fillers, your meaningless expressions. So that's the challenge for me this morning. I'm going to try to not say or so, or like. I think they do that in Toastmasters, don't they? If you say one of those, they ding a bell on you. Anybody a Toastmaster? All right, so hopefully that was some practical knowledge to warm you up a little bit after your long night.
It is what it is.
It is what it is, yes! That's a great one. That's a great one. I say that all the time. Thank you for sharing.
I have to say it.
All righty, well, hey, here's another one while we're on that. This is kind of fun to talk about before we get into type. You know, here's something that I've tried to do. When somebody says thank you to you, it is so hard for us to say, you're welcome. You know, like we'll go, no problem, or no, thank you, or, you know, anything else. But just take a moment to acknowledge that somebody has taken the time to say thank you. We complain all the time that nobody thanks us for what we do. And when they say thank you, receive it, okay? I don't know where I got off on that, but just some practical advice. All right, so what we're really going to talk about, by the way, what's our time frame? When do you guys want me out of here? When you start nodding off, or what's our time frame? An hour?
Or less.
Or less. All right, let's go for less. Here's what I do. I like to try to be your most popular speaker. So if you give me an hour, I'll try to do less, because then you'll be happy with me that I got you out early. Okay? So we'll aim for that. All right. Stacy Crone is here with me today, and she actually works here locally with Mr. Cohen. And I actually came from Central Florida. So I'm just really glad y'all are here today. So I drove all the way, yes, y'all. I'm from Polk County. I'm from Imperial Polk County. So anybody know what's the main attraction now in Imperial Polk County? No, it's not in Polk County. It has to do with a new theme park.
Legoland.
Thank you. Thank you. Yes, Legoland is open. And you're all welcome to come. And you can stay at my house if you like, because I'm hoping that with the opening of Legoland, that maybe we'll get something like a Panera Bread or an Einstein Bagels. So if you guys come up and buy passes and keep Legoland in business, maybe I'll get some form of a good coffee shop in Winter Haven. All right, so Stacy's handing out to you what we're going to talk about, and generally what we're going to start today off with is talking about fraud, all the bad things that are going on out there, and how these fraudsters are staying up day and night to try to dupe you. And what we're going to walk away with today is how you can protect yourself, how you can be reactive. So if you see this coming on you, you can say, whoa, let's take a moment, take a breath, and evaluate this. And how you can also be proactive in building your business so that you have filtered out some of that before it even comes at you. So that's the overall theme of today, is we want to evaluate fraud. Now, while we're doing that, as Seth mentioned, I do come from a title insurance underwriter. So that's my capacity. We talk about underwriting risk. So my background is going to be from the title insurance perspective. And what I'm going to give you today is some very practical ways you can understand how title insurance will protect your customers from fraud. And I'm going to give you some examples. So you guys can kind of sit back and relax a little bit, because basically in the next 45 minutes or so, I'm just going to tell you a bunch of stories. And I might get some oohs. Oh, did that really happen? Okay, and it's basically going to tell you how title insurance can protect you as well as your customers. And I always tell this story with realtors. You know, it's great to have a wonderful closing agent. We're going to learn that in some of the stories that we talk about today, the importance of networking with a trustworthy closing agent. But ultimately, your clients are going to remember, as part of their closing transaction, who are they going to think of first, or at least who you hope they're going to think of first, is you, okay? Which is great when they want to refi or sell again, but it's bad if something goes wrong, right? Because you've already closed the deal, and then you've got to do a whole bunch of cleanup afterwards, and they're going to remember you. So even if it's a title issue, they're still going to call you first. And then you will have to call Seth. And then sometimes Seth will have to call us to get a resolution on it. So this is important for you to be able to explain to your client, look, title insurance is a big deal. You need to understand how it protects you. You need to be able to at least have that 2 or 3 minute conversation of how title insurance covers you against certain risk. And the great news is that our title insurance forms, which is all that paper that's in the front of the jacket and the back of it, it's all that fine print that nobody ever reads except us title people. It's changed to be really customer friendly, and we're going to talk about how it really protects your client's interests. So let's start big picture about what title insurance is. Title insurance is just like any other insurance. We underwrite risk. My husband, as I said, just opened his law firm, and we are in the process of trying to get health insurance, and it's a nightmare. Health insurance is a type of casualty insurance. What are some other examples of casualty insurance?
Car insurance.
Car insurance. Or in real estate we have hazard or homeowners insurance. And what does casualty insurance insure? It ensures that if something happens when? 2 weeks from now, after you've paid your premium, if anything happens after that fact, if your house burns down, if you go in the hospital, or if you get termites, whatever the case may be, it goes forward in time. Title insurance is not casualty insurance. And in fact, under Florida laws, we cannot be casualty insurance. What that means is title insurance goes back in time. And that's critical to understand, because we underwrite risk a lot differently than a health insurance company would underwrite if you're going to have a heart attack 20 years from now. Okay? And also, one of the biggest distinctions about that and the underwriting of it is title insurance you pay how many times? Once. Until you sell it. And that means you have a new property. For your casualty insurance, you pay for that every quarter or however indefinitely, as long as you want it. So when people come to you and they look at that closing statement and they go, why is title insurance so much? And you can say, because it's a one-time payment. As long as you live in this house, or even if you die in this house, your heirs will have coverage under that title insurance policy. So we have to underwrite risk differently. How do we underwrite risk? We don't evaluate how old you are or the structure of your house or anything like that, or if you're in a floodplain. We evaluate what's happened in the chain of title up to your date of closing. So we eliminate or reduce our risk by evaluating the chain. Okay? And the value of it is if we miss something that's happened already, and they say, hey, somebody comes knocking on your client's door 2 weeks after they moved in, and they say, hey, you didn't pay a code enforcement lien that was there before you bought, then that's a claim under the title insurance policy. If it was there and we missed it, then we'll take care of it if it's a valid claim under the policy. So different than casualty insurance, the one-time premium. We also have, I wanted to mention this to you because it came up last time I was down here with you guys, is some of the new protections is under the new forms that were just approved in March is even if someone transfers it to their trust. Previously that would have ended title coverage. Under the new policy, if your owner decides for estate planning purposes or what other reason that they want to transfer to their trust, they fall within certain guidelines, that trust is still covered as well. Okay? Generally speaking, if you transfer the property, your coverage is over. But if it's your trust, and there's also some provisions if they have like an LLC and they're the member manager and they transfer it to their own LLC, coverage would still continue. So that's a big deal. You don't have to buy a new title policy. So some advantages of title insurance because it's not casualty insurance and how we react to it. So on your materials today, I have some information about how we're going to be proactive and how we're going to be reactive when we're evaluating these risks. And mainly they relate to fraud. So we've talked a little bit about how title insurance is going to protect you generally, but I'm going to give you some pretty specific examples. And then we're going to talk about recognizing the red flags. So the point today is from these stories, each of these little items that I tell you should kind of fit in as a red flag that this may not be a good deal. So I gave you some generalities about how title insurance protects you, but let me give you a couple of just basic examples of how title insurance could affect your client if they were in this situation. So let's start with the residential example. Let's say that your client is a young couple. They just bought their first home and it was their dream home on a golf course. Between the contract and closing, the homeowners association in this golf course decided to put a restriction on the entire subdivision that the property would be for only 65-year-old and older people. And of course, your clients are in their young 20s. This happened between contract and closing. And funny, the sellers didn't mention anything about it to anybody involved. Even though I'm sure they had to give notice, I'm sure they had to sign something in order for this to be passed. So we get to closing, your young couple moves into their home, the welcome wagon comes to welcome them in, and they open the door and they clearly see that they have not met the 65 and older restriction. So a few days after that, or your client gets a notice saying, you're going to have to move out of your dream home. Doesn't sound like a good situation, does it? Well, the point is that restriction that was placed on the property before closing, we should have caught. So that would have been a claim under the title insurance policy. Now, we have different ways we can remedy that problem. And the first way we did it was, we're going to just pay for you to buy another piece of property. In other words, that would have been pretty much a complete loss for us if we had insured your client as the owner of the property. Because they're saying, I can't live there anymore. And I'm in violation of these restrictions. Well, the husband agreed to that. But then the wife calls our claims counsel and says, this is my dream home. Crying, I don't want to leave. So we ended up working out a deal with the homeowners association where they got one variance for this couple, allowed them to stay there, and in addition to that, when the couple tries to sell the property, if there's any loss because of marketability, keep in mind, when they bought it, there was no restriction on the property. Now, their buyer's base has gotten considerably smaller. You know, we get questions about what does marketability of title mean? That's a classic example. If you were to sell it, you'd make less, or you may not be able to sell it at all because now you have this age restriction on the property. So that was a claim that title insurance took care of. Here's an example for commercial side. We had a racetrack and a shopping center side by side, very small parking lot, kind of out in the adjacent area between the two pieces of property. They both sold in the same year, but unrelated transaction. Both had surveys on the property. Very important in a commercial transaction to have a survey. Well, come to find out, both surveys showed both owners as the owner of the parking lot. Any of you that do commercial deals, parking lots are a big deal. So the mall didn't really need the parking lot except during holiday season when the major parking lot was full and they had to park way out. The racetrack actually needed that parking lot for access into their property. Huge deal for a title insurance. If you can't get to your property, you can't use it legally. And that's a major claim under the title policy. So we worked out, in fact, it got so bad they were duking it out, putting up fences between the parking lot and all this kind of stuff. So we had to work out that issue because both of them had owner's policies. So I'm sure we paid quite a bit of money for that very small parking lot. So some general examples about how title insurance can protect your clients. All right, let's talk about the covered risk. And I have there under Section 2, this is actual language of the title insurance policy. I did you a favor and I didn't give you the whole front jacket because it would have immediately put you all into a coma right now. So I just excerpted certain portions of it that hopefully will be somewhat in English for you to be able to understand. So it starts off by saying subject to the exclusions, exceptions, and conditions, meaning we're covering a lot of things, but we're also excluding a lot of things too. So you got to read the whole policy. We, as the underwriter, insure as of date of policy. That's where that backward thing comes from. We're saying as of the date of policy, this is where your title stands, not afterwards. Anything that happens after the date of policy is actually in one of those exclusions, okay? So as of date of policy, we're insuring against loss or damage, not exceeding the amount of insurance. So in a sales transaction, your amount of insurance is going to be what?
Sale price.
Exactly right. What they pay for the property. And for a loan policy, it's going to be what amount? The amount of your loan, okay? What they financed. Okay, so that's going to be the amount of insurance. And of course, we're not going to pay any more than that amount. So we're insuring against loss or damage sustained or incurred by the insured by reason of. And then we have this language that says any defect in or lien or encumbrance on the title. And prior to this year, that was not defined. That's just how the sentence stopped. And unfortunately, that meant we had to rely on a lot of courts to tell us what that meant. Now we have, this year, under the new forms, we have some examples. Caused by what? Forgery, fraud, undue influence, duress, incompetency, incapacity, or impersonation. Those are some pretty normal verbs. Like when you think of the word forgery, you kind of go, well, okay, I can understand that. Fraud, I can understand that. So let's get some examples about this. And another thing I want to point out, when we're talking about these fraud examples, generally speaking, these are going to result in a complete loss in the title policy. My example I gave at the beginning of the class where you just, somebody comes and says, oh, somebody's saying there's a code enforcement lien on my piece of property. Well, that usually means we can throw $5,000, $10,000, and the problem goes away. A lot of these, the people never get good title. That means if we have issued a policy for what they paid for, and let's say we're down in Boca, let's say it was a $500,000 house, then we are out $500,000. To correct that problem, we have to pay usually policy limits. So that's why these are such big risks for us to be examining. So let me give you an example of forgery in our real world today. We were examining chain of title where we were having a transaction involving a sale for $350,000, residential piece of property. There was a questionable deed back in our chain of title. Here were some red flags. So these are things that if we come up with, if Seth says, I'm looking at a deed and it looks fishy, I got to call my underwriter, this is exactly why. So here's what she saw. To avoid paying the transfer tax, it was declared a gift on the face of the deed. Let me remind you, not all of these things by themselves mean fraud. But when you lump them up together, it could mean fraud, and that means you need to ask more questions. And usually what we find out is when you start asking questions, your deal goes from bad to worse. And then you say, it's not looking good. Okay, so gift. It was not recorded by a title company. So when you looked at the deed, if it was recorded, it didn't say return to the title company. Just, it looked like somebody just walked in the recorder's office and recorded. Here's a great one. The deed was handwritten. The handwriting matched the signatures on the document, including the notary. So it looks like somebody just went through and signed every single signature on the document. And we laugh at this, but how often do you sit down and look at the deeds? Even the deeds at your closing, how often do you examine the signatures of those deeds? Well, I can tell you we're examining them a lot more closely because of things like this. The notary stamp had the notary's last name, but when they signed it, they misspelled it based on the notary stamp. So when they signed it, they didn't spell it the right way that the stamp had it. Here's a great one. The notary's name was listed in their office postings as a suspect, and any documents containing this notary stamp should be scrutinized. The grantor's signature, the seller's signature, did not match signed documents recorded previously. So once we got those red flags, we said, let's go look at some other documents signed by the seller, and those signatures didn't match. All right, and finally, when they did have the filled out when recorded mail to, it didn't match the seller or the buyer. Why would you want to send it to somebody else that's not a party to the transaction, the deed going back to somebody else? So we ended up running the grantee's name, the buyer's name. Who's this buyer and where did he come from? Because this is looking fishy. We found out that he owned approximately 70 other properties, which he suddenly became the owner of. 70 other properties. So we called the property owner to find out if he had executed the deed to this buyer. And of course, what was his answer? I have no idea what you were talking about. It was a complete forgery. They had no intention of selling the property. They looked up this guy because, of course, they had his name now on there as the buyer, and this was a foreclosure scam. So he had, the way this did, he had his brother working with it. They had been charged with over $1.5 million in foreclosure fraud, where they stole the stamps of notaries, forged hundreds of deeds. So basically the bottom line here was they used the funds to pay off all those mortgages, and they basically put them in their pockets, and they had this lavish lifestyle, which they went and searched and found all kinds of things that they were using from these fraudulent transactions. But that's an example, forgery of, if we had insured that deed, and that buyer says now, and of course when these guys go into title, they don't bother to pay off the real outstanding mortgage on the property, right? They take the proceeds of the loan, and instead of paying off the mortgage, they put it where? In their own pocket. So that mortgage, after about 6 months or so, becomes delinquent because maybe 1 or 2 payments have been made. They might shell out a couple just so it gives them some space and time, but it's never paid off. And then we have a foreclosure on your buyer, sitting in their recliner watching TV. What's going on? Why am I being foreclosed on? I paid my money. I did everything I needed to do. So that's right there in those coverage provisions. The first thing listed is forgery. Another thing to remember too, we're seeing a lot of this lately, is forged satisfactions. Whenever we see a piece of property that is free and clear, we call to double check that examination of the title, because there are not that many that are free and clear. Without something, if we see a release of mortgage, usually we want to see a new mortgage after it because they've refinanced and they've put more money into it. Anybody that pays off a $600,000 mortgage and doesn't put anything new on it, we're going to question that. A lot of times we found out that those are actually forged satisfactions. So of course if the property's free and clear, there's no lender to pay off, right? So they just put all that money again into their own pockets. But of course the lender has no idea that the property's even been sold, and they're waiting on their payments, and they're going to try to foreclose. So forged deeds and forged satisfactions. So let's look at our list here of evaluating forgery risks. We have kind of our reactive ways to handle that, which is our beware, and then our proactive, which is our tips on how to avoid forgery risk. The first one is if all contact is made by email or phone and they refuse to meet you in person. We hear these stories all the time. They will never come to meet me. They're always busy. I never see them. Documents signed outside of a professional's presence. We have tightened our requirements. We used to have closings all the time where we mailed them away. I used to, when I worked in Orlando for the law firm, we did closings for this guy who plays some golf here and there, and he's pretty good, and he also runs into mailboxes. But anyway, we did his, I'm saying, anybody know who that is? Okay. I'll let them tell you if you don't know. Who was it? Tiger, okay. We did some of his closings. And anyway, I got lost. Why am I talking about Tiger? Oh, mailing away documents. We used to do closings in this great subdivision there in Orlando where Tiger was buying a lot. Lots of golf pros in the subdivision. In fact, this is kind of cool. Tiger bought like 9 lots together, and he built a golf course around the back of all those lots. So he wanted to have all those lots assured that they're together. This is really interesting title insurance stuff, right? So we had to make sure all those lots were together so he could put his golf course on the back. But we used to all the time send documents out to the golf course. You know, we'd get it to the caddy and they'd find a notary and they'd sign it and then give it back to us. That's not going to happen anymore these days. We're going to say, look, if you need to mail it away because they're out of town or whatever the case may be, we'll find somebody in another state. Fidelity offers that to our agents. We're a national company. We'll find somebody that will sit down and explain that and meet with them and look at their notary or their ID, have a notary sit down with them, make sure that this is the person. We have all kinds of stories about people not being who they claim to be. And there is nothing like having somebody sit down face to face. I don't know if you all have had the experience when you're actually at the closing table and the person says something and you realize this deal is not going to happen. It could be something as simple as they have no idea what's going on, and I'll give you an example of that. Or we've got a problem, and they said something that they didn't even know gave it away. Okay, we have that happen all the time, and that's not a good deal. All right, so we want to have that face-to-face communication when we have a closing. No blank documents. You know, notaries are not allowed to notarize a blank document, and we should not be accepting any blank documents. And also, after a notary has signed a document and notarized it, if somebody goes behind that and makes a change, technically that notary needs to re-notarize the document or that change is not valid. You can't just unilaterally go and change a document. So the notary is a very important person in this whole evading fraud. Recent acquisition or recent payoff, we already mentioned that when there's no outstanding mortgage on the property, and the deed's not prepared by an attorney or title agent. And we say that not to say you have to use a title agent or an attorney on every deal. It's just smart to do it that way, because they know how to handle the transaction and they know how to recognize these red flags. So your proactive tips: sit down in closing, verify the notary public's identity and signature, and then also know your parties to the transaction. There's nothing like knowing your parties. And that's one of the reasons that Seth wanted me to come down and talk to you, because he relies on you knowing the parties. Because you spend a lot of time with these folks. And like I said, they'll say things to you that they probably would never say to Seth. They'd be scared to say to him. And you can go, you know, that doesn't sound right. Maybe I should ask Seth about that. And Seth will go, you were right to ask about it. But he would have never known it but for you. So that's one of the reasons why we like to come out and explain this to you and the value of working together. All right, one thing I wanted to mention here when we're talking about forgery, the value of notaries, is they should know what they're looking for when they are notarizing documents. We have fraud alerts that go out all the time that explain how you can get a fake ID in the state of Florida, what to look for. You know, some important things like, how about you look at the name on the driver's license? Make sure it's the same name as the name on your documents. Things like, has it expired? If it's an expired driver's license, it is not a valid form of ID. if you look at the picture and it doesn't look like the person that's sitting in front of you. We have had that happen. And we look back in the notary files and go, did you not? I mean, because literally these notaries will take the ID, stick it in the copy machine, and stick it in their file and never look at it. Front and back copies of the driver's license. And what we also say is if you have any questions, ask them for another form of ID. It doesn't have to be, you know, an insurance card or anything like that. But hey, do you have a Sam's card? Do you have a credit card in your name? We've had agents tell us once they ask that question, they leave the office and they never come back. A lot of times if they forge one piece of identification, they don't think they need anything else, so they don't get anything else with that fake name on it. So those are some ways that we tell our notaries how to help us against forgery. So now that we've talked about knowing the parties to the transaction, we're going to talk to how that can help you avert fraud. And this is a scheme involving misdirection of payoff funds in a foreclosure rescue scam. So you guys, I'm sure, have heard about all of these. This particular company was called Help Is Here Foreclosure Prevention. And that just makes, to me, this story all the more sad because they're under the guise of actually helping people to avoid foreclosure. So here we're going to be talking about the fraud risks. Here's the fact pattern here. We had this foreclosure prevention or short sale specialist. And what he did was he was in cahoots with this loan payoff specialist. That was her name. She called herself a loan payoff specialist. So basically what happened was this loan payoff specialist would provide bogus payoff statements to us as the title company. So we would get a payoff statement, think this is valid, and pay it. She claimed to work for a finance company and she claimed to have authorization to issue these payoff statements as the loss mitigation specialist. So the property then goes to this individual. His name was Lewis, this Help Is Here Foreclosure Prevention Company. His name was Lewis. He either went in title individually or as a trustee. And then, of course, the idea was he's going to resell the property. You know, he's going to help clean it up, get it in shape, and then resell the property. And help these people get out of a bad situation because they're in foreclosure. Of course, all of the money and the negotiations were through this loss mitigation specialist. After the deal closes, the fraudsters tell the title agent to wire funds to an account that they, of course, control. So the money goes to that account. The existing mortgage on the property is never paid off. Again, we get with the new homeowners in a piece of property, they get a foreclosure notice that the prior mortgage hasn't been satisfied. So there we would have potential loss for the new owners because they bought the property and they're now being foreclosed. As well as if that new owner got financing, we would have also issued a loan policy. Because the owner's policy covers the owner, that you own the property. If they get financing, the lender's policy covers the lender that they have a first position mortgage. Well, when somebody comes up to the plate and says, I'm foreclosing, that lender that we've insured no longer has first position. So we have a double claim on our hand in situations like this. The owner's policy we have to defend as well as the loan policy.
Why would a title company or a closing officer forward funds to an account other than the mortgagee if they were paying off a mortgage?
Well, in this particular instance, it looked like it was the mortgagee. It was just bogus from the get-go. Now, another answer to the question is sometimes title companies do stupid things. And we as Fidelity like to pride ourselves in getting smart title companies. And we keep our title companies appraised of this. Now, you guys remember when the short sale boom started. How many of y'all went to like 10 short sale classes? Because I talked for like 3 years about short sales. Okay? We were cranking out short sales and nobody really knew what they were doing. And of course, these fraudsters were going to jump in on it too. And of course, who do they find? The ones that really look like they don't know what they're doing. And they're going to go back to them again and again and again. And if it doesn't work with that title company, you know what they're going to do? And they will threaten to do it, and it's probably happened to Seth. They'll say, I'm going to take my deal down the street. And at some point we say, have at it. Because it hopefully will not be a Fidelity underwriter that has to face that claim. We have some great stories about deals that have, we've turned away. Sometimes our agents actually call us and say, I need you as my underwriter to say no, that you're not going to insure this deal because it's a bad deal. Okay? And again, that's the value of title insurance. Sometimes we make mistakes. We're not perfect. Now, don't tell anybody after you leave this room that Seth isn't perfect. But we're not. And that's what insurance is for. It is to take care of mistakes that happened in the past. Okay? And hopefully it's not going to be one that is our example here where it's a complete loss of title. Maybe it's something we can throw some money at and make it go away. Okay? All right, here's another example. This was brand new. I think I just got this in my email yesterday. And by the way, in the time I was sitting out in the foyer, my first 2 emails that came through this morning, both of them were on fraud. So that's where we are. Okay, here we are in another mortgage fraud scheme. And believe me, I have other stories besides mortgage fraud, but we'll get to those too. We have a straw buyer. Okay, straw buyer means they're never really going to go in title. They're just using the name. And a lot of times they call this cash for credit. Sometimes they pay somebody like $10,000 to be able to use their name in the credit. So they pay this straw buyer $10,000. And of course that straw buyer does nothing. They have nothing, no skin in the game. They haven't paid any money to be involved. They're just going to give their name and then put $10,000 in the pocket after the deal closes. So here's how this works. The parties close the transaction on a Wednesday for $550,000. The straw buyer obtains a mortgage in his name for $495,000. So all that looks normal. However, the loan application had these false statements: inflated monthly income, inflated bank balances, and inflated assets. We've heard this story before, okay? So the lender was wired over $500,000 to the title company. The title company issues a check of about $150,000 to this shell company, meaning it is only a company to put money in and go out. It does nothing else. And this was the ringleader who owned this shell company. Here's the kicker. This $150,000 disbursement was not disclosed on the HUD-1. It also happened before the real closing. And you see what happens if money goes out before the closing? What do? They use out of that $150,000, they put $10,000 in the straw buyer's pocket, and they take about $70,000 and they bring it to closing for the straw buyer to use as their down payment. So they're actually using money from this transaction to fund the buyer's side of this transaction. And that is fraud for a couple of reasons. First of all, it's not disclosed on the HUD. Do you think the lender would have ever closed that deal if they knew that money was coming from a third party? And you wonder sometimes why lenders care where the money came from. This is exactly why. Now, in this deal, the title company was actually involved. And that's why this deal happened. So again, another advisory for you: be careful who you work with. Be sure you can trust them. Because this title company, it would have never happened but for this title company wiring those funds out before closing and allowing them to turn around and be used in that same transaction. So we found out later, of course, that these folks were indicted on 14 different scams. They had qualified for almost $13.5 million in fraudulent loans, and they'd actually pocketed almost $3 million of that fraudulent loan money themselves. Okay? So again, could have never happened without that escrow and title company. Another one that I heard, this was just this week as well. This one struck my eye because I just got this email, and Stacy may have gotten it too, where our agent says to us, nobody else says we have to do this for a closing. Well, let me tell you something. If we tell you you have to do something for a closing, it usually protects you in addition to protecting us. We, as title companies, are in the same boat as you. If the deal doesn't close, we don't get paid. We've done a lot of work and we really want to get paid. Okay? If it doesn't close, we don't get paid. So if we have a requirement that seems to be a stinker requirement, there's a really good reason for it, okay? So the complaint here was, no other company makes us do this. This has to do with a short sale letter, payoff letter. Here we have a sale transaction through Bank of America is the short sale lender that we're trying to pay off. We're using a short sale negotiation company in this situation. There were no real estate agents involved. I was hoping at least that would get a what? No! That's just a red flag right there in and of itself, isn't it? No real estate agents involved. The buyer was purchasing the property using a private lender. The sales price was $200,000, pending approval from the existing lender. The short sale didn't happen quickly enough, so we had to have an extension of a few days, and then the payoff letter came in and appeared to approve everything after we got this extension taken care of. So we got in our HUD approval, we got the short sale payoff letter, but our agent was looking at this going, this doesn't really look right. The bank approval letter. Any of you worked with Bank of America on your short sales or work with them? Their first thing that got her thinking that it was a problem was it didn't come through the Equator system. I guess normally your approval letters would actually come through the Equator system. She didn't get it that way. She also tried to call the person who had signed the HUD approval, left a voicemail message, and didn't get anything back. And his title on his approval was Senior Operations Analyst, Business Operations. So she thought that was odd. Why is a business operation guy signing a payoff for a short sale? Usually it's a loss mitigator that's going to be signing these short sales. So she got a return phone call from Bank of America, said that this guy's not with loss mitigation, although he was with Bank of America. And the approval letter was completely bogus. The seller had never even applied for a short sale. And get this, the outstanding loan balance for this $200,000 deal was over $1 million. What? I'm sure she's thinking, I guess we're not going to close this afternoon. Probably not. So our agent calls the seller to say, hey, we've got a problem. We don't have short sale approval here. But they didn't return the call. They just said, please send me all the documentation, which of course she did not do because she knew at this point we have a problem. Of course, the guy never called her back. We called the buyer to say, we've got a problem, it's not going to close. And the buyer's response was, really? Maybe the buyer was involved too, if they're not really surprised that this deal suddenly isn't going to go through. And then we tried to call the third-party negotiation company, and they never contacted us as well. So we finally did return the funds that we had already received, anticipating the closing, and we confirmed it was going back to the right place, the rightful owner. So in this situation, we were able to avert this fraud, but only because we were taking time to read through it. Not every deal these days is a good deal. Okay? So an example of fraud relating to the short sale payoff. So when we look at our evaluating fraud risks, beware. How we're going to react is if there's any irregularity on the closing statements, any increased commissions, odd payoffs. You know, we used to have the days back in the day where people would come in and go, I want to pay off my credit cards, and oh, all of a sudden I got this bill, just throw it in the 1300 series and, you know, here's an invoice and just pay it out of closing. Or, you know, the seller would come in and go, well, I want the money to go to my sister-in-law, so instead of cutting a check to me, cut $15,000 to me and $10,000 to my sister-in-law. And we did it. You know, as long as everybody agreed. Well, that's not the case anymore. We have to be careful about that. And most importantly, the lender has to approve those HUDs. Everything has to be disclosed on that HUD, what we're doing with the money.
Christina, I just want to add one thing. I had a situation yesterday, and this is more on the commercial side, but one of our larger law firm agents is doing a closing out of state, and Fidelity is now requiring the payoff letters to actually have us listed on there as well. So you may see that more and more, that either the agent and or underwriter are going to be requested to be on there.
You know, that's an interesting comment because, as Seth mentioned, I do training for our agents throughout the state, and we're talking about all kinds of risks in the market that we're in. And one of the things that we are seeing generally, and I'm sure Seth can tell you stories, is that the lenders are trying to shift some of this fraud risk on us in this room. So what they are doing is exactly what Stacy mentioned. They are putting more pressure on Seth to do more things. His loan closing instructions letters have probably gone from 1 to about 15 pages. And you have to check everything off. And he, as a closing agent, has to sign his name saying he did everything they wanted. And if not, he has to send it to them, and somebody with the right authority has to cross off number 72. Okay, we'll take off that. And has to send it back to Seth, and Seth has to sign it again. So these are all the things that are going on in the background that we're trying to protect ourselves from the lenders that are trying to shift some of that risk to us.
Guys, if I could add to that, when we're sitting in closing and we finish signing the loan package, and then I say, great guys, now I got to get a funding number, this is what I'm talking about. We have to send just about every document that was signed by the borrower to the lender. Somebody should be waiting there for that package. We have a closing. Oftentimes, they're out to lunch, they left for the day, and we can't disperse, meaning give everybody their checks and say bye and congratulate until we have that funding number. That's been for years, but now it's even important, more important than ever before. So.
And a lot more back and forth with you and the lender before you even get to the closing table. I was laughing as you said that because back when I was doing closings, we used to have to send like those 40 pages in a fax.
Right.
Now at least have email, but and we were scrambling to get the overnight packages and do all of that. So yeah, some ways that we can evaluate the closing statements will help us in evaluating these fraud risks. Inflated appraisals, I've got a couple stories on that. Exclusive use of one appraiser. We used to see the problem with appraisers overvaluing property. They call that flipping, and I guess now they have this new term which is called flopping. Have y'all heard of that? I think it's kind of silly, and maybe I have misunderstood this concept. But to me, the basic premise of flipping and flopping, besides being a great way to wear shoes on your feet, is that it's all a fraud based on false evaluation or false valuation of the property. So in a flip, they say you, let's see, the flip, you priced it too high. Okay, let me see about this. The flop, it's priced low, too low. And then you go to the next sale from A to B and you sell it at market value, and now you've made money because it was too low. That's the flopping. The flipping side was you bought it and you added to it and you made money on the flip side. It was overvalued on this side, so it really wasn't worth what you're asking for. In the flopping scheme, the end buyer actually gets what it's really worth. It's just that it was undervalued in the first place. So all of that hinged on these appraisers either overvaluing the property or undervaluing it. So again, that goes to your network of appraisers that you're working with. Be careful who you use there. Multiple
We don't
holding
get to
companies.
choose them.
No.
Exactly.
Well, that's probably a good thing.
Well, the problem with that now is that sometimes we get appraisers in Delray from Miami.
Exactly.
It's ridiculous. They have no clue.
I agree, it's ridiculous.
And because
I won't tell you why, but I completely agree with you.
They need to know the market and the,
Yes.
and the community, the area.
a lot of them are incompetent too.
Yes.
Yes.
Well, and you got to think about this. We'll get off our soapbox here in a moment, but why would that? Obviously, I guess they're saving money or something, but why would you not want to have an appraisal that is the true value of the property? And see, the deal with the flopping thing, the reason that's hurting us a lot is because they're actually undervaluing it on the initial sale. So as if we're not in a bad enough situation, you're undervaluing it. The latest stories are like $100,000. You know, how does that affect your neighbor's equity when that happens? And then the money doesn't go to the lenders, doesn't solve the situation with the lenders, it goes in the fraudster's pockets. So, you know, again, hopefully we can be somewhat the gatekeepers here with these situations. All right, we'll get off our soapbox. My last tip, there's a great one. Excessive pressure and urgency to close. We get that all the time, especially on those short sales. We're finally going to close. Let's close now. It doesn't matter. Go, go, go. And then your tips, again, know your parties to the transaction and scrutinize questionable transactions. It's never a bad idea to ask more questions. You know, as I get older in life, I don't mind playing dumb anymore because I would rather have too much information and ask a stupid question than not have asked the question and wished I had afterwards. All right. Let me give you a couple more things you may not have heard of, quick stories. The next one I had on, if you looked at page 1, we cover failure of any person or entity to have authorized a transfer or conveyance. That's under paragraph 2. We talked a little bit about the forgery and the fraud, some examples there. We're talking about authority here. Does the person who's signing your document actually have the authority to sign the document? The latest thing we're seeing here deals with adverse possession. And some of these are right around here in your neighborhood. Here's what happens in this situation. These people go into properties that have been abandoned or in foreclosure, so it doesn't look like anybody owns it. They make a claim for adverse possession, and that's a legal term that means basically you can go into a piece of property and claim it as yours against the true owner. It has to be adverse. So you have to say, I'm living here and they're not allowing me to live here. If you do that for 7 years in Florida and you meet the legal requirements, you can terminate the prior owner's rights and you can live there. Now, from a title insurance perspective, we're just not going to let somebody say, hey, I met the requirements and I win. And we're going to do a deal with them. We're going to make them go to court, and a judge has to say, yes, you now own the property. And we're going to have to make an order from the judge saying you now own the property because Florida law says you now own it. We used to, back in the day, they used to call these people squatters, right? Because they went, they said, this is my property, and if I stay here long enough, if I pay real estate taxes and clean up the property, put a fence around it, they'll know it's not mine. Well, that's happening now with these foreclosed properties or properties that have been abandoned. You probably have clients that said, I'm just not going to deal with this anymore. I'm just going to leave. The other side is they'll say, I'm just going to stay. I don't want to work out any deal. I'm going to stay as long as I can and not pay anything. Well, in this case, they're gone. In Broward and Palm Beach counties alone, adverse possession claims have been filed on some 200 homes in recent months. So what they do is they put something of record that says, I'm claiming this property by adverse possession. Sometimes the property appraiser will put them on title or on there as an owner on the tax records and the property search records. So when we check it, we'll see 2 owners. We'll see the real owner, the title owner by way of deed, and we'll see, in fact, one of them was some little Pambino nation or tribe. It was actually an Indian tribe that said they were owed by the United States government, and so they were taking all this property by adverse possession.
It's not a casino.
Yes. They issued their own driver's license. They were this big happy group. So they're saying, I own this property. Well, what's happening is these folks are saying, hey, I claim it. And here's what they're doing. They claim to be do-gooders. They are actually renting this property out to third parties. And you know what they're doing with the rent? What are they doing with it? They are putting it in their pocket, which is illegal because they have not gone the 7 years to own the property by adverse possession. And they're actually being arrested. I think one of them, I said there was one in 100 homes in Broward County. 3 of the homes in Palm Beach or in Lake Worth. The names of them were called Saving Florida Homes again. And I watched a video of one of these guys, and they over in Fort Myers area. They actually say, I am doing a good thing. This house is sitting there. Why not let people live in it? It's helping them. Well, of course, then you think, well, when they get the foreclosure notice and are evicted, can you imagine? And I went back to Fort Myers, and they said the police are so overwhelmed they won't even go anymore because it's like a property dispute. And they're not going to get involved in that, so they don't go and evict them. It's crazy out there. This one guy had made $20,000 in income from tenants before he was arrested over a few months' time period. So he was making him pretty good money. All right. I'm going to give you one last story. We're done. All All right, this is, has to do with the authority to convey the property, which is another thing that's covered. So in that case, if we had insured one, like if your buyer had gone and bought a property from that little Pambino nation who claimed by adverse possession, and then we realized they really didn't have title. They didn't have the authority to sign that deed, putting title into your client's name, that would be a claim that would be covered under title insurance. So here's another example of somebody not having authority. This could also go back to the incapacity or incompetency of a transaction. We had a little old lady who was going to buy 2 pieces of property. She was going to do it as part of the 1031 exchange. The seller was rushing this little old lady to closing for each of these. She was going to buy each of these, and the seller was pushing. We've got to get this deal closed. The buyer came into into closing to sign. She executed the documents as trustee of her family's trust. And of course, it went into the exchange accommodator because it was a 1031 exchange. Title went into the 1031 exchange company. The next day, our closing agent got a call from Adult Protective Services saying that she might have had dementia. The old lady may have had dementia. Right there, let me tell you, if somebody does not have mental capacity to sign a document, that could be challenged. The entire transaction could be challenged and voided, meaning it's like it never happened. So that would be a problem if your buyer was the one that was buying these houses. So, okay, the buyer doesn't understand what she's doing. So our agent says, well, we missed one small document. So let me call the seller and say, oh, we can't close immediately because we missed one signature. So the seller says, well, we'll just go ahead and sign some kind of addendum. Have her sign some kind of addendum. We can waive this. It doesn't matter. Just get it done and clean it up quickly as possible. So they tried. The closing agent said, I still don't feel right about this. Let's bring her back in. And at this point, she could tell that the elderly woman was confused about. The properties were explained to her. She was buying them as is. They were in a very bad neighborhood. The little old lady had only seen pictures of them. She was told that she was going to buy them and immediately start collecting rent, which didn't appear to be the case after they looked at the pictures of the property. So again, going from bad to worse. So she mentions in closing, hey, I have an attorney. So our title agent says, well, let me call the attorney and find out what's going on here. In the meantime, Adult Protective Services comes back and says, yes, she has dementia. The guardian has been appointed for her. So we know we have a problem at this point. We can't close based on any signature that she's had regarding the closing of the transaction. The attorney had no idea that a trust had been created. Nobody from the elderly woman's family reviewed any of the closing documents, so she had no guidance in this transaction. There was a conflict of interest here now with the attorney, so he said, let's not close this. We found out that when we looked at the trust agreement, which sometimes we don't look at them, and there are reasons why we don't, and don't have to. But in this instance, because of the red flags, we looked at the trust agreement, and guess who was the successor trustee of the little old lady? The seller. So on this trust, it looks like old lady is the trustee. And again, people know when we don't have to look at the trust and when we don't want to. Well, in this case, when you read through it, who's the successor trustee? That's even worse than being a beneficiary. Successor trustee means I have all the power and I can do whatever I want with the trust property. So buyer doesn't understand it. We call the seller, and the seller says, don't worry about her not understanding. I have in my back pocket a durable power of attorney. Let's use that. Mysteriously, now that she's been declared incompetent, let's use a durable power of attorney. Of course, we're not going to be able to use this. And you can't, by the way, you can't use a power of attorney for a trust, because the power of attorney was for her individually, not for her as trustee. And there's different requirements if you want to use that in a different capacity. So in that case, had she been incompetent, she would have not had the authority to transfer the property to your client. If your client had gotten the property, title insurance would have covered that. Okay? So let's wrap up here with our closing points. how to successfully evaluate risk. Our proactive ways we can do that is, number one, you had a brief little tip on how title insurance protects your customer. So you can at least say, hey, it protects you against forgery, fraud, and if somebody doesn't have the authority to sign the documents that are putting you into title. Network with trusted professionals, get to know your customers, and keep asking those questions until you get reasonable answers. And then be reactive by recognizing the red flags that we've given you today. Trust those gut instincts. That's why we have a relationship with you. If you have something that doesn't seem right, please call us. We would like to discuss that with you. And I always